The price of automobiles continues to rise, and cars and trucks have seen the biggest price increase since 1969. Just the opposite of what most people had predicted when this shutdown began back in March. Hey everybody, JJ here on the BX4. We got a lot of news to cover today as we continue to see the propping up of this bubble economy, this debt-based economy. The biggest bubbles of all time that we're seeing in many different areas of this economy, including the housing market. I think automobile prices are in a bubble. It's an absolute one gigantic debt bubble. All right, so let's talk about why this is happening. We've got some other news to cover as well. But remember, back at the beginning, I said they're going to try to keep this economy propped up. They have unlimited funds they can use. It's a fiat currency. And many people said, no, JJ, you're crazy. There's going to be an absolute crash, deflation. Prices are going to drop in housing and automobiles. It's going to be a wipeout. And I said, well, why would they let that happen in the year 2020 with everything we have on the line, or everything they have on the line this year in November? And we're talking about our officials, our quote-unquote leaders. All right, so let's talk about this. We saw the banks completely deregulated back in March. Banks can now lend out unlimited amounts of money. They don't have to have any money in reserves. So why would it surprise you that prices keep rising? This is the biggest rise in used car and truck prices in over 50 years. Does that make sense that this is happening during the worst, some people will call it a Great Depression 2.0, but the worst spike in unemployment since the Great Depression? Well, of course, it should make sense. Banks do not have to have any money. They can loan out unlimited amounts of money. It's pretty simple, and it shouldn't be a surprise to any of you that have been following this channel. So used vehicle prices are 12% higher than they were just 2 months ago. So a 12% spike in 2 months. Now, there's a lot of different factors here. It's not just banking and lending. That's a huge part of it. But you also have a lot of people leaving the cities that used to depend on public transportation. We also have more people now afraid of using public transportation because of the illness. Also, there's more crime, especially in these larger cities. Big spike in crime. So that's raising demand for people buying cars and trucks. And it's even more amazing considering we saw the liquidation of tens of thousands of vehicles from the bankrupt car rental agencies like Hertz. But even with that extra supply being put on the market, the demand still outweighed the supply, and we see these spiking automobile prices. Absolutely insane, but when you look into the underlying factors in the banking system, not so insane. It pretty much makes sense. But remember, this is based on debt. People are not buying cars. The majority of people are not buying cars and trucks in cash. Most people are taking out loans, taking on more debt. Yes, eventually it'll blow up. It doesn't mean it's going to happen tomorrow or next month, but eventually it will blow up. Another article points this out as well. This is consumeraffairs.com. New car prices also continue to rise in September. Consumers paid an average of $38,723 for a vehicle last month as of September. Also, a report here out of Business Insider. This highlights a chart that was put out by Axios, Axios.com. But this shows you now that we're 6 months into the shutdown recession, Great Depression 2.0, that long-term unemployment is spiking. And we saw this happen at the beginning of the financial crisis. Here we are now, 6 months into the shutdown recession, Great Depression 2.0, and we see spiking long-term unemployment. And what happens when you're unemployed for a long time is you don't get counted in the official unemployment number. So our officials can go out there and they can point to how great the economy is, and they can show you the official unemployment number, how it's dropping and getting lower. It's below 10%, it's now 8%. But it's a meaningless number, or it has little meaning, I should say, because you have to look at all of the people that fall between the cracks, people that didn't qualify for unemployment. A lot of people working for cash, under the table, working for tips, are not going to qualify for unemployment. And the long-term unemployed also not part of the statistic. If you want to get a gauge of the unemployment, the real unemployment number, go over to Shadow Stats. We look at the blue line here. And although it did drop, it went from 35% down to, it looks like about 26.5, 27%. So still not out of the woods. But when you look at the difference between the official number that is touted on the media at about 8%, and we see it's really 26, 27%, it's a pretty simple way to see the kind of deception that's put out there. So what's the solution? Well, this is a Bloomberg article right here. Central banks in QE overdrive to finance deficit spending. So all of these rescue programs, it's going to be more and more debt that can never be paid back, but they'll try to convince you that it can be paid back. They're going to say you have to pay a bigger chunk of your paycheck to fix this problem. So it's going to be the people on the hook, the working class, and eventually there's going to be very few people working as this economy is going to lean more and more towards people just permanently dependent on a handout. Remember, a lot of the jobs that people had before they got laid off or before they lost the jobs, those jobs are only created, they were only in existence because of debt and spending and lending and pretending. And what happens when we see lower production and more spending? Well, we see rising prices. Here's an article here, OregonLive.com. Yes, your grocery bills have gone up. Food costs surge in September. When you look at the official inflation number, they will not tell you that. They don't factor in food and energy, for example, two big things that need to be factored in this. They also need to factor in home prices and the cost of rents and other necessities, cost of living, that they also don't factor in there. So it's more manipulated, false, flawed data that we need to really look into to figure out what's really happening in the economy with prices. Finally, right here, Yahoo Finance, mortgage delinquency rates hit a 21-year high. Well, I guess it's okay because we can just put on moratoriums. People don't have to pay their mortgages. And I guess the landlords, they can just go on forever without paying, their bills, maintenance, upkeep, insurance, all the things that go along with owning a property or a multi-unit complex like an apartment building. So no one has to pay their rents, no one has to pay their mortgages. It can just go on forever. Nothing bad's ever going to happen. So you don't have to worry about anything. You don't need to prepare because this can go on forever. Alright, I think you guys know the truth. We need to prepare. How long can this last? We have the big event coming up in early November. Is that going to be a turning point? Are we almost at the end of this grand economic illusion? You let me know. Mortgage delinquencies 21-year high. Long-term unemployment spiking the most since the beginning of the Great Recession, which was about 12 years ago now. More borrowing, people taking on more debt. Prices still rising in homes and autos. Doesn't look like it's going to be a good ending, folks. Prepare. Be ready for something big to snap and break. Be prepared. Thanks everybody for watching. Bye for now.